Hello students, this video will discuss Learning Objective 2 of Chapter 5. We will begin with types of income. There are several different kinds of types of income. First one, you can receive income from services. The most common source of gross income is payments for services such as salary, wages, and fees. These payments from services are rarely exempt from taxation. Income from services is also called earned income. This one, please see example 5-7 on page 5-10. Also, income can come from property. Income from property is also called unearned income, such as gain or loss from sale of property, dividends from stock ownership, interest from savings account, rents, royalties, and annuities. This one, please see examples 5-8 to 10 on pages 5-10 and 11. Annuities. An annuity is an investment that pays a stream of equal payments over time. Number one, annuity can pay over time over a fixed period, or number two, annuity can pay over a person's life as long as a person lives. A portion of the annuity payment is a return of capital. That's the original amount that you put in the annuity, in which is tax-free, just like the return of capital, and the remainder of the same payment is taxed as ordinary income. So let's look at the annuity exclusion ratio. Or this one, how do we come up with this? Original investment amount divided by expected value of annuity equals the return of capital percentage. This one, please see example 5-11 on page 5, pages 5-12 and 13, right here. For this one, for annuities with a fixed term, the expected value is the number of payments times the payment amount. In January, Graham purchased an annuity for $99,000. The annuity pays her $10,000 per year for the next 15 years. How much of each $10,000 payment should Graham include in her income? So here, let's look at the description. Investment in an annuity contract, she pay $99,000. And then number of payment is $10,000 for the next 15 years. Return of capital payments, that will be 6,600. How do we do that? 1 divided by 2. And number 4, amount of each payment will be 10,000. So gross income per payment is the $10,000 amount that you receive minus the return of capital. So we'll come to the $3,400. Also, the annuity could be over a life, and for this is you need to use the IRS tax the tables to determine the expected value based upon the taxpayer's life expectancy. This one is a little bit more complex, but there are programs that can actually tell you how to put it into a program where you can generate to determine what portion of each equal payment of the annuity will be subject to tax, which one will be considered the return of capital. Property dispositions. Here is the basic formula for calculating gain or loss from sale of an asset. First, you're going to start with sales price minus your selling expenses, like fees or commissions to the broker or agent. That will equal your amount that actually realized, minus your tax basis and properly sold, which means how much money you put in to acquire this property. Then it will come to your gain or loss on this sale. This one, please refer to example 5-12 on page 5-13. And also, there are other sources of gross income. For example, income from flow-through entities. Taxpayer may receive income and deductions from distribution of the partnership and S corporation to be reported on their personal returns. When taxpayers actually receive cash from the flow-through entities, the cash amount is first considered a return of capital investment. When the amount of cash distribution exceeds the taxpayer's investment amount, the excessive amount is treated as taxable income, generally treated as ordinary income. This one, see example 5-13 on page 5-14. Another one will be a very unpleasant situation regarding alimony. Alimony is legally defined as 1. A transfer of cash made under a written separation agreement or divorce decree. Number 2, the separation or divorce decree does not designate the payment as something other than alimony. Number 3, in the case of legally separated or divorced taxpayer under a separation or divorce decree, the spouses do not live together when the payment is made. This one is especially important. You cannot be divorced and still live under the same household and paying the other person alimony. That is going to be disqualified. Number 4, the payments cannot continue after the death of the recipient. So one of the spouse, the spouse supposed to be receiving the alimony dies, then there's no ongoing. You don't pay to the estate of that spouse. When payments qualify as alimony, the recipient must include the amount in gross income, and the payer may deduct this amount for AGI. This one, see example 5-14 on page 5-15. And also for property divisions and child support payments, these two do not qualify as alimony. So you cannot count them as alimony. This one, please see example 5-15 on page 5-15. If taxpayers attempt to make huge payments in the front end of the divorce decree and substantially smaller ones, the tax law may require the taxpayer to recapture or recapture part of the alimony payment as non-deductible property transfer. This one, see example 5-16 on page 5-16. The reason why sometimes maybe they think, well, if I can deduct more when I have a higher income tax rate, then maybe I can just sort of shift my deduction, more deduction when I earn more money. And in the later years, when my tax rate is lower, then I pay a smaller amount of alimony. What about prizes and awards, or maybe gambling winnings? All windfall amounts are included in gross income with narrowly defined exception to exclude such amount. This one, please see example 5-17 on page 5-16. What about Social Security benefits? For those who are receiving Social Security benefits is taxable up to 85% of the benefits in calculating gross income, depending on, number 1, the amount of the taxpayer's filing status, number 2, the Social Security benefits, and number 3, modified adjusted gross income, or what we usually call MAGI. Modified adjusted gross income, or MAGI, is the adjusted gross income AGI minus minus Social Security benefit plus tax exempt interest income minus foreign income minus certain 4 AGI deductions. For detailed Social Security benefit calculation, see text and example 5-18 on pages 5-18 and 19. So here are some of the examples. How do you calculate your Social Security benefits? Imputed income. Number 1, bargain purchase. Employee discount less than employer's gross profit percentage or up to 20% discount are excluded. So you cannot have allowed the employee to buy something extremely cheap. This one, please see example 5-19 on page 5-19. And number 2, below market loans. I think I discussed this maybe before. Near zero interest rate. We loan someone with a below market interest rate. Between the employers and employees, that will be considered commonly taxable indirect economic benefits. So they need to impute that interest income because they're below the market rate interest. Discharge of indebtedness. This one means forgiven debt must be included in the taxpayer's gross income. Please see example 5-21, page 5-21. Unless the taxpayer is insolvent before and after debt forgiveness, then the discharge is excluded in gross income. So if you borrow money from an individual and the person say, oh, forget it, you don't need to pay for it, which means based on this rule that you have actually received that forgiveness amount of payment. This is quite common for those people who actually default on their mortgage, and the bank actually issue a forgiveness in certain amount. Those taxpayers were also hit by another surprise, because those debt forgiven actually are reported to the IRS, and the taxpayer must include that in their gross income. So for this learning objectives, we look at different types of income. And if you have additional questions, please practice those examples and those problems in the back of the chapter and post the question accordingly. Thank you.